Welcome yet again to another session on tax matters with Dennis Wakaba. My name is Mikaeli Jisang and I'll be a host for today. So we'll be hosting CPA Dennis Wakaba, who's a tax expert with experience on tax matters across the globe. He's also a board treasurer and a member of ISPAC. He has a master's in science of finance from the University of Nairobi. And today we really want to get deeper around matters taxation, and we'll be looking at international taxation, to some extent, think advanced pricing agreements, and also significant economic present taxation. Now, to start us off, there's been a lot of effort from the government around taxing international entities. Has this been something that has happened in the past, or is it something we're seeing coming up currently?
Okay. First is to thank you for having me and to our listeners as well. Many thanks for lending us your ear. And to go to your question, yes, a lot has actually been happening recently and also in the past on the issue on taxation of international entities. You want to think of companies operating in more than one jurisdiction. And this is, you want to think of a company which has its presence here in Kenya and it has its presence in another different country. Think of the USA, think of Australia, think of the UK, and those, and any other jurisdiction that is outside of Kenya. So a lot has actually been happening, and we've seen the Finance Act of 2025 now closing into into these entities with some certain introductions into the law, with some certain very salient and very clear wording of the law. We've seen in this particular Finance Act now do introduction of APAs. We call them APAs. These are the Advanced Pricing Agreements. And just recently, this past year, in the month of November, we saw the publication of mutual agreement procedures. We've also seen the government scrapping the digital service tax and in place now introducing the significant economic presence tax. We've also seen in the recent years the introduction of VAT on the supply, on digital supplies, on various players. We've seen the government, I hope you are going to be conversing about this, we've seen the government closing in non-resident taxpayers who are not paying taxes here in Kenya. And we've also seen now a totally different conversation happening in international space. That is the import of digital supplies at the point of importation. There's a lot of conversation in our that space, and I hope we'll be in a position to mention a thing or two about it.
Okay. I like that you've talked about mutual agreement procedures.
Yes.
Think of the layman's. What does that really mean?
Mutual agreement procedures, it's a provision in the double taxation treaties that Kenya have. And with double taxation treaties, we mean there are some friendly countries that we've approached and we've agreed that we do not want to be taxing incomes derived between the two countries by people living in, or rather by residents in the two countries twice. So what then we are saying is that in most cases, the mutual agreement procedures is usually contained in Article 25, in most cases, in Article 25 of these treaties.
Okay.
And it's just a way of resolving tax issues whereby a non-resident company that is drawing, or rather has economic influence here in Kenya, of course, to some extent or rather to a great extent, becomes a taxpayer here in the country, would in most circumstances find itself in a tax dispute with the Revenue Authority. And so what then happens with the mutual agreement procedure is that non-resident company invokes Article 25. Like I said, it can change depending on the particular DTA, the double taxation treaty that we have. It invokes that article and then it seeks justice. And this justice is sought in a way that Usually it's the agreement between, we call them the competent authorities of one nation, and then agrees with these taxpayers on the way to resolve this conflict. And so even that other country, even the non-resident can even opt now to seek justice using the local law, the domestic law, or it can opt to invoke the MAP, the mutual agreement procedure, as envisaged in this particular DTAs. And so it is just a way of resolving disputes. If you are thinking of a tax assessment, if you are thinking of the interpretation of a particular article in the double taxation treaties, like for instance, one of the provision you're going to find in most DTAs is a certain percentage of payments, think of consultancy, management and consultancy. For most non-residents, when you're making that kind of payment, then we tax it at a higher rate. But now these agreements between these two countries come and say we are going to tax this at a reduced rate of maybe even 5%, 10%, or a reduced rate. And then there might be a dispute on whether a particular payment ought to have been subjected to withholding tax rate. And so that non-resident may opt to seek justice, may seek now to utilize what we are calling the mutual agreement procedure, invoking the provision of that particular article, other than utilizing the domestic clause. However, I must mention that that particular non-resident may also invoke domestic law in place of the mutual agreement procedure. And so the two actually go together, only that now, unlike maybe the domestic laws, you as a taxpayer are supposed to invoke the mutual agreement procedure within a period of 3 years. Yeah, so if after the lapse of 3 years you've not invoked this particular provision, then that window then comes to an end. And I also want to mention that maybe why 3 years, and in most cases we know the period for seeking justice is usually it's not 3 years, it's not as much. So it gives now the taxpayer at least now the option to have utilized the legal justice, the local legal justice that we have here domestically, before now it goes to inter-country way of resolving a certain tax dispute. So that was made clear with the publication of guidelines by the Kenya Revenue Authority in November of 2024. And it's a very good provision because it gives clarity, it gives the way forward to the aggrieved taxpayers on what they can do. Even though we've had quite a lot of court judgments, it wasn't clear on how to handle these particular court cases. So it's clear now, and I think it goes towards giving clarity to aggrieved taxpayers.
Okay, great. You mentioned something around APA, and of course, you'd think fast, the writing style. But
Yes.
in terms of
Yes.
advanced pricing agreements in the context of transfer pricing,
Yeah.
just demystify this APA for us.
So APAs are applicable to, we mostly call them MNEs. These are multinational enterprises, or a company, again, that is operating in different jurisdictions. So you find that a related taxpayer is dealing, or rather a taxpayer is dealing with a related entity in a different, again, jurisdiction. So you find that because I'm dealing with a related entity that is within the group, you find that these related entities sometimes price the activities in a manner so that to shift the profits to a less taxing jurisdiction. So if the taxes in one country are high, then the pricing between these two particular entities is going to be in a manner that the profit is going to be shifted to a different country that is not taxing as much, doesn't have maybe high corporate tax rate, or even in some instances doesn't have a corporate tax rate altogether. So now what the advance pricing agreement then is coming to do is coming to resolve the issue of the pricing between these two related entities, because what happens is that there's something we call transfer pricing, whereby because we don't want these two related entities shifting their profits to a country with less tax rates. So we are saying, because we want this pricing to reflect the market rates, we require you to provide to us how you arrived at these prices. And that essentially, in a very layman language, is what we call transfer pricing. But now you find, yes, I may prove to the revenue authority that this is how I did my pricing, this is how I arrived at the prices, this is the method. There are quite a number of methods that you can choose. This is the method I used, these are the comparables that I chose. I have all the facts. But now you may find that KRA comes and then says, no, this is not the way forward, why this? And then you find them reviewing these prices. And of course, this now results to high taxation to the local entity. So with the advance pricing agreement, I will now be in a position as a taxpayer to approach the revenue authority, and then we agree, I see concurrence, that all these are the facts, these are all the relevant or material and relevant circumstances to these particular transactions, to these particular dealings that I have with the related entity, and these are this is the method that I chose to use, and these are all the facts that I can put on the table. So because I've sought concurrence with you, and we have put this in writing, then I cannot come back and say that I'm going to change this particular pricing method that I chose. I have sought concurrence with you, so I will not expect you to come back to this. And it so happens that sometimes it can take quite a lot of time. It can take a lot of time to agree on. And so you find the effective time usually is 5 years. If you've agreed on a particular method of pricing these activities, then this method is going to run continuously for 5 years. This is even though we are expecting now the publication of new transfer pricing guidelines, because currently we've been using ones that have been placed since 2006. So we expect that even though they are in draft copy, we expect that they are going to be, we are now going to have a publication that is going now to have this provision of advanced pricing agreement being captured in these guidelines. So it's a very welcome move, because it gives clarity, gives certainty to the dealings between related entities, and it goes along towards now making long-term decisions to these taxpayers.
Great.
Yeah.
You had talked about SEP, so significant economic present tax.
Yeah.
Break it down for us. Assume we do not understand what it means.
Okay, so a significant economic presence tax is a tax that was introduced again in December 2024. And before that, we had what we are calling the digital service tax. Yeah. So we had the DST at the rate of 1.5%, but now that has since been replaced by SEP, what we are calling the significant economic presence tax, at the rate of 3%. So it is applicable to foreign taxpayers, or rather to foreign entities who are supplying goods locally digitally. So you want to think of such businesses as streaming services. Think of music, movies, podcasts, and all those kind of enterprises. You also want to think of such thing as online learning platforms. You want to think of digital marketplaces. You want to think of cloud storage and hosting services. You want to think of software as a service, what many call maybe SAS. and also the selling of digital goods like ebooks, games, and stock and stock photos. So what happens is that these particular taxpayers, they may having an influence in our economy. But now, because they do not have that physical presence here in Kenya, then the government really tries to figure out how are we going to correct tax for the revenue that these particular entities are earning from our country. And therefore, we saw now the introduction of SEP at the rate of 3%. That is in the Tax Laws Amendment Act of 2024. But now, what the finance bill has done is that it has removed the threshold because it had required that only persons who are making sales of more than 5 million were required to register for SEP. So now this has now been increased. Doesn't matter the value of your supply, long as you're making supplies here in Kenya in the digital space, then you would be required to register on iTax for SEP so that you can be doing your filing. And in addition to that, before the SEP and the digital service tax, we saw the government also close in into the digital space on the taxation of the supplies being done in this space by introducing VAT on digital supplies. So the rate of VAT is a standard rate of 16%, whereby the Kenyan residents now, for the supplies being done here in the country, then it is being charged at the point of the consumption, at the point of paying. So it is incurred by the consumer, by the Kenyan resident, and like now the significant economic presence tax, which is taxed by the foreign supplier, the VAT on the digital supplies is being borne by the consumer. Of course, going along with the canon of taxation, that is the principle of taxation of, the principle on which VAT is premised on, which is the destination principle, where we say that VAT should be borne by the consumer. Yeah, so it is a consumption tax, and we've seen now the government now closing, and the government actually even went ahead to make publication on the regulation and guidelines on this space. So I think it's evident that the government is closing into the international space, and you would expect, of course, it has to come along with a lot of challenges because people can be paying for these services, and they must not necessarily even they must not necessarily have that visibility. Yes.
Okay.
Yeah.
You've talked about, at some point you mentioned about non-residents not paying taxes.
Yeah.
What's all that about?
So you find, again, like I mentioned, you find that there are non-residents who are earning income here in Kenya, but they are not paying their fair share of taxes. So what we've seen in the Finance Act of 2025 is that now it has introduced agency notices that can be issued to the parties dealing with these particular entities. And with agency notices, what this means is that if we can shift a little bit to a local taxpayer, if there's a taxpayer, a company here in Kenya that has not paid its taxes, and the revenue authority is after them to pay the taxes, they've agreed these are the taxes due, but the company has not paid its taxes. So what the commissioner actually does have an allowance whereby they can approach the parties' dealings with these taxpayers and require them to pay amount outstanding to these taxpayers directly to the revenue authority. You want to think of the bank.
Yeah.
If a company is holding a bank account with a certain bank, then an agency notice may be issued to the bank requiring the bank to pay the amount that it's holding on behalf of this company to the revenue authority. It can also even reach to your customers. Like if I've sold to you and I've not paid, then the revenue authority can require me as a customer to pay all the amounts to KRA that owes to that particular taxpayer. And interestingly, if you are found not to have obeyed that agency notice, and you pay this this amount to the customer and not the commissioner,
Mm.
then that amount becomes due from you legally.
Ah, it's
Yes.
like you're an agent now.
Yes, you act as a collecting agent.
Okay.
So this has now been increased. It was not previously captured
Heightened.
for the non-residents, and now the commissioner will now have the ability to issue agency notices to parties dealing with us, to party dealings with this non-resident. And so it's going to be interesting how this is going to be enforced. Of course, given in mind that there might not be that much visibility on the parties dealing with these non-residents.
Okay.
Yeah.
That's great. I like the conversation we had around the digital supplies.
Yeah.
Talk of digital imports. Are there custom taxes? What's in that space?
Again, it's been a very interesting conversation in the international taxation space, whereby, as you would expect, if you're importing something in a different country, it goes through the port, right?
Yeah.
When it reaches to the port, it has to pay custom duty. But now, we cannot say that digital imports are not imports. In essence, they are imports.
Yeah.
If you're importing maybe think of things that you're paying digitally, then there has been conversation in the international taxation space whereby the revenue authorities are asking themselves, yes, these are imports, yet customs are levied on imports. Can we then look into how we can enhance tax collection by way of customs on these imports that are being brought into this country? And it has been a very interesting conversation. It's an ongoing conversation, and currently, of course, given the fact that Kenya is adopting a lot of practice that, the best practices across the globe, and what really you would say supranational entities, think of the OECD, are providing as guidelines for the taxation to other countries.
Yeah.
You also want to think that Kenya as a country, of course, is going to take that direction, and we are going to see in future. It's a space that we are going to keep our eyes on, because we are going to expect that in future, then the revenue authority and the parliament, because it's the authority that makes laws. We are going to see the parliament, of course, make laws to impose custom on importation of digital supplies. So it's one of those very expectant and very ripe space that we are expecting a lot to be happening. Yeah.
Okay. Thank you for the session. I think it's been enlightening. We've learned quite a lot around international taxation, digital space taxes, and also just the imports we were talking about a few minutes ago. It's been a great session around Assurance Africa. Thank you, Dennis, for for gracing us this time. In the next session, we'll talk about e-teams as we continue to dissect matters taxation. Welcome. Hit subscribe, like the video. Thank you.